Picture this. You're standing in the grocery store holding a receipt. $220. You look at your cart. Same items you always buy. Same brands, same quantities. 3 years ago, this cart cost you $140. Nothing changed in your shopping habits. Nothing changed in what you needed. $80 just disappeared from your wallet for buying the exact same life you were already living. You feel the frustration of it. But when someone asks you to explain why, the best you can do is something costs more now. And that answer feels inadequate because it is inadequate. It describes the symptom without touching the mechanism. Here is what nobody explains clearly. Inflation is not a malfunction. It is not a natural disaster that arrives uninvited. It is a designed output of a system built with specific beneficiaries in mind. And understanding who those beneficiaries are is not an economics lecture. It is the most useful financial map most people never get handed. By the end of this video, you will understand not just what inflation is, but who designed the system that produces it and who gets to be on the winning side of it. And you'll have 3 specific moves for getting yourself on the right side of that transfer. If that sounds like the explanation you have been waiting for, hit subscribe. Let's get into it. Let's start with what inflation actually is. Not the government's definition, not the Federal Reserve's 2% target, the real definition. Inflation is what happens when more money chases the same amount of goods, when the amount of currency in circulation increases faster than the amount of things that currency can buy. Each individual dollar becomes worth less. Not worthless, worth less. The goods did not get more expensive. The money got cheaper. The price tag on the cereal did not go up. The dollar in your wallet went down. The distinction matters because it tells you where to look for the cause. The primary mechanism for money supply expansion in the United States is the Federal Reserve. The Fed does not print physical dollar bills in the traditional sense. It creates new money digitally through a process called quantitative easing, buying treasury bonds and other assets from banks using newly created reserves. Those reserves enter the banking system and through the bank's lending activities multiply into a broader money supply. When the Fed significantly expanded its balance sheet between 2020 and 2022, from roughly $4 trillion to $9 trillion, it created an enormous amount of new money in a short period. The goods and services available in the economy did not double. The money supply approximately doubled. The result was the highest sustained inflation in 40 years. This was not a mystery. It was arithmetic. Now here's the part that changes how you think about the whole system. New money does not enter the economy evenly. It does not land in everyone's bank account simultaneously like rain. It enters at a specific point through the banking system and the financial markets, and it flows outward from there. The people and institutions closest to the point where new money enters the system get to spend it before prices have adjusted. The people furthest from that point receive the new money only after prices have already risen to reflect the new supply. This concept has a name. It is called the Cantillon Effect, named after an 18th century economist who first described it. And it is the single most important concept in understanding why inflation benefits some people dramatically while harming others, even when both groups are experiencing the exact same inflation rate. Here is how it works in practice. The Federal Reserve creates new money and uses it to purchase treasury bonds from large banks. The banks now have new reserves. They can lend against those reserves at a significant multiplier. The new money exists in the financial system before it exists in the grocery store. Asset prices rise first. Stocks, real estate, commodities. Then goods and services prices follow. By the time the new money reaches ordinary wages, prices have already moved. The wage earner receives their inflation adjustment after the cost of living has already gone up. The bank received its adjustment before. The inflation tax is not paid equally. It is paid most heavily by the people furthest from the money creation point, which is most people. So who does inflation actually benefit? 3 specific groups. First, asset owners. When new money enters the system, it flows into assets before it flows into consumer prices. Real estate values rise. Stock prices rise. The person who owns a house or a diversified investment portfolio watches their net worth increase in nominal terms, sometimes significantly, during inflationary periods. The house did not get more valuable. The dollar got cheaper. But the asset owner's balance sheet reflects the new higher nominal prices, and their wealth increases in the only measure most people track. Second, debtors with fixed-rate debt. This is the one that surprises people. If you borrowed $300,000 to buy a house at a fixed 3% interest rate, your monthly payment is locked. It does not adjust for inflation, but the dollars you use to make that fixed payment become cheaper over time. You are repaying a 2021 debt with 2027 dollars that are worth meaningfully less. The bank lent you money that was worth more and is being repaid with money that is worth less. Inflation is quietly reducing the real cost of your debt every single year. Third, the government. The United States carries approximately $36 trillion in national debt. When inflation runs at 4%, the real value of that debt shrinks by 4% per year. The government borrows dollars that were worth more and repays them with dollars that are worth less. The same mechanism that benefits individual mortgage holders, but at a scale that removes trillions in real debt burden over time. The government has a structural institutional interest in moderate, persistent inflation that it would be impolitic to state directly, but that the math makes completely obvious. Now, who does inflation actually hurt? First, cash savers. Every dollar sitting in a savings account or a money market fund earning below the inflation rate is losing purchasing power every single day. The number in the account does not change, but what it can buy shrinks continuously. The person who saved $100,000 and put it in a standard savings account during a period of 5% inflation and earned 0.5% interest lost approximately $4,500 in purchasing power that year on paper. The account said $100,500. Reality said $95,500 in last year's dollars. Second, fixed income earners whose wages lag inflation. Think about your salary increase this year. If inflation ran at 6% and your raise was 3%, your nominal income went up, but your real income went down 3%. You are working the same hours, producing the same output, and receiving less purchasing power for it. The labor market adjusts wages more slowly than inflation adjusts prices. The gap between wage growth and inflation is paid by workers. Third, anyone without assets. The person who owns nothing, no real estate, no investments, no inflation-hedged assets, experiences inflation entirely as rising costs with no offsetting nominal wealth increase. Their cost of living rises while their balance sheet has no asset appreciation to compensate. Inflation without assets is a pure purchasing power tax with no rebate. So what do you do with all of this? First, own assets instead of holding cash. This is the single most direct way to move from the losing side to the winning side of inflation. Assets appreciate in nominal terms during inflationary periods. Cash erodes. The shift from cash holder to asset owner is the most important financial transition most people can make. Not because assets always go up, but because they participate in the nominal price increases that inflation produces while cash does not. Second, understand your fixed rate debt differently. A fixed rate mortgage during a period of meaningful inflation is a financial asset, not a liability in the traditional sense. You locked in the cost of a large purchase in today's dollars, and you repay it in future dollars that are worth less. This does not mean take on reckless debt. It means understand that low fixed rate borrowing against a hard asset is one of the few mechanisms available to ordinary people to benefit from the same inflation that reduces their cash savings. Third, measure your income growth in real terms, not nominal terms. Your salary going up 4% during 5% inflation is a pay cut. Your salary going up 8% during 4% inflation is a genuine raise. The only number that measures whether your financial position is improving or deteriorating is the gap between your income growth and the inflation rate. Anything above inflation is real progress. Anything below is real loss, regardless of what the nominal number says. Go back to that grocery store. The $220 receipt. The $80 that disappeared from your wallet buying the exact same life. That $80 did not vanish. It transferred. It moved from your purchasing power to the balance sheets of asset owners, to the reduced real cost of debtors' fixed payments, and to the diminished real value of government debt. Inflation was never just prices going up. It was always a transfer mechanism operating continuously and invisibly. The question was never whether inflation would affect you. It always does. The question was always which side of the transfer you were on. Now you have the map. The rest is positioning.